Welcome, and thank you for tuning in to ESG Talks, a KBRA podcast series focusing on environmental, social, and governance, ESG. This podcast series highlights various ESG hot topics and includes commentary from prominent voices within the ESG community. In this episode of ESG Talks, Dana Bunting, Senior Managing Director of KBRA's Business Development Team, interviews Judy Wesalo Temel, Senior Vice President and Director of Credit Research at Fiera Capital. Judy leads the fixed income credit research team and is responsible for approving or not approving the purchases of a broad range of municipal and corporate credit, including state and local governments, higher education, healthcare, infrastructure, utilities, transportation, financials, and other sectors. She directs the development of credit policy, databases, and other tools to manage clients' portfolio credit risk. Judy also plays a key role in Fiera's U.S. ESG strategies.
Emily, thanks so much. I'm Dana Bunting. And before I start, I just wanted to say that Judy and I are longtime industry friends and actually spent time some years ago sharing an office. So this is really exciting for me. So Judy, as you're aware, interest in ESG investing has exploded over the past few years. Why is ESG important to Fiera, and how has your ESG strategy evolved?
Well, great. Well, first of all, Dana, thank you so much for having me on this call. I'm Judy Wesalo Temel, and I'm really excited to be talking with you. So ESG has been important to Fiera for many years. Fiera was actually one of the early signatories to the UNPRI, and the way that investment teams incorporate ESG factors into the analysis continued to evolve as the field itself and the data has evolved. So our clients and our investors are increasingly demanding more information, more accountability about what they're investing in. Each investment team looks at their own asset class in a different way with their own criteria, but the overriding investment goal is to be a global leader in ESG integration, to provide investors with income and capital appreciation through performance, but at the same time mitigating risk by embedding these ESG factors into our analyses and investment process.
Thank you. We're seeing a very similar phenomenon from our own investor clients. They're really craving more ESG information. And so this is a space that KBRA is increasingly entering to facilitate better quality ESG disclosure. But is ESG simply about excluding bad companies? Does your firm invest in companies that are improving on ESG metrics or incrementally transitioning in a sustainable way, even if right now their absolute ESG evaluation is relatively low for their particular sector?
So that's actually a great question, because in the early stages of ESG, it really was mostly about negative screening, meaning I don't want firearms, I don't want tobacco, I don't want fossil fuels, and that was it. But now, as there's more of an understanding about the need for a greater holistic understanding of a company, adding all the different factors and an integrated analysis, and also that ESG issues are often issuer and sector specific. So pointing out the important areas in one sector may not be the same as another sector. And there's also a growing recognition about the interlocking and interdependency of ESG issues. So for example, what happens to local economies as traditional jobs in one sector that perhaps in energy or coal disappears? What happens to those local economies? What are the social implications for the people who live there? How are they going to learn new skills in the future economy? And is there going to be population migration within a country or from one country to another because of climate? And how do you deal with all of these issues? And this is something that the industry is really grappling with.
Wow, that's a lot to absorb. It's also really helpful, Judy, and very similar to how KBRA views ESG issues. Our approach to ESG is a bespoke process because ESG risks and opportunities are often very specific to the issuer and sector in question, as you mentioned. And to your point about the interdependency of ESG issues, that's a really good one. It's why KBRA is currently not offering a separate ESG product, because we feel as a rating agency It is far too difficult to weight social factors against environmental factors in a non-subjective way. And that is the question of impact is best left up to the investor. So that leads me to my next question for you. There has really been a rush to market of ESG data and analytics. Can you talk more specifically about your firm's process for evaluating ESG impact? For example, are there external sources that Fiera uses, or do you rely more on in-house ESG analysis?
Well, so we use a combination of both in-house and external data sources when we do this. And again, each investment team has a complementary but different process from other investment teams. So in talking about how we look at municipal credit and how we look at corporate credit here, we've developed actually a municipal model over the course of the past couple of years, and also a model for scoring corporate credits. When we look at impact, which is again different from ESG, we look at the use of proceeds. That's such an important component to see actually where the money is going. And now what we do is we map them to the UN Sustainable Development Goals. So on the muni side, many of the issues that you see for impact are actually in healthcare and education, clean water, or infrastructure. On the corporate side, measuring impact can be determining if the company or organization is providing a service that may help serve an underserved community or makes tangible impact in improving the environment or work conditions. And we look at how a project progresses. So you look at the impact of, say, building an addition to a community college and how that impacts the local economy in terms of additional jobs that you can trace to the number of graduates of that community college, or acceptances to four-year colleges where a student might not have gotten in before, or increased non-traditional student use of the facility. And these are all important to the investor because they're actually seeing a positive impact, and that's a key motivation for their investment. And you're right about a rush to market by providers of ESG data. So there are the large global providers. There are also ESG information providers that have been acquired by the rating agencies themselves. And then there are providers that focus on climate risk, ones that focus on social issues, and ones that specialize in looking at controversies, particularly on the corporate level. So all in all, a burgeoning market, but with trying to get objective, reliable information being the gold standard.
It's a lot to absorb. One thing we hear a lot from investors is that with this information deluge, there is the need for more consistency in the ESG space. But ESG issues are also evolving so quickly, which makes consistency that much more difficult. Do you think that we can create standards and common frameworks within the ESG space while also allowing for them to be dynamic as ESG issues evolve over time?
Yeah, so that's a great question, and one that can be discussed for a very long time. I'm approaching this from the US point of view, as opposed to the European point of view, where there are actually more standards in the marketplace there. But focusing on the US, one way of answering this is to see what the SEC is doing. And with the new administration, in March, they issued a statement requesting public input on climate change and also on broader ESG disclosure. So it was an extensive letter. But some of the questions included specific information on climate change and should there be a third-party standard setter? Should there be a third-party verification and assurance on the data? And should these align with international standards? All of these are questions that they're asking investors to answer. Now, this may create more consistency of data within specifically the climate area. For instance, they're asking how markets are currently using quantified information. Are there specific metrics on which all people have to report, such as scope 1 or 2 or 3 greenhouse gas emissions? And what are their greenhouse gas reduction goals? and what kinds of measured information should be disclosed, because it actually is material to an investment decision. In addition to climate, they're also asking about what the market thinks about frameworks for social and environmental factors. So with this regulatory interest, I would expect to see more discussion on data going forward.
That's a really great point. We've definitely seen heightened regulatory attention on ESG, especially after the Biden administration took office, as you just referenced. One last question for you. Do you feel investor and consumer focus on sustainability and ESG integration will grow or diminish post-pandemic?
So the short answer is yes. And the longer answer is yes, this will continue. The pandemic brought to the forefront many of the ESG concerns that investors had been talking about for some time. But to put it in context, the total US assets under management using sustainable investing strategies grew from 12 trillion at the beginning of 2018 to 17 trillion at the start of 2020. So an increase of 42% just in those couple of years. And that represents a third of the dollars of US assets under professional management. So this has been a trend that we have been following, and so much more focus on this. Concerns about climate, about social issues, and about good governance are going to continue to resonate with investors long after this pandemic is over.
Thank you, Dana and Judy, for a very interesting discussion. This concludes our episode. New episodes of ESG Talks air every other week. In the meantime, please visit KBRA.com to access our other podcast series, as well as our ratings and research.